Hello, everybody. My name is Eric Amzalag. I'm a certified financial planner, professional, and the owner of Peak Financial Planning in Woodland Hills, California. This video is how I evaluate rental property decisions for clients. This is a question I get all the time from clients. I work with two specific cohorts of clients, pre-retirees, retirees. So this is within the first 5 years of your retirement or the 5 to 7 years leading up to your retirement. The second cohort I work with is self-employed families, couples specifically, that have one self-employed or two self-employed partners. And I help them make wise financial independence and retirement decisions. Rental property is a very common question. Should I take a portion of my surplus cash flow or my current savings invested in rental property? Is that a good wealth building or retirement income strategy? Disclaimer, this video is not personal financial advice, but I will be going through two detailed numbers-based scenarios, one for a property in California, which is where I'm located, and one for a property elsewhere in the United States, which feels more like a normal rental market or a normal purchasing market, because California can feel inflated, has all sorts of unique constraints. This video is not personal financial advice, but it is designed to be very thorough and give you a look into how I, as a financial fiduciary fee-only certified financial planner, help clients make this decision and evaluate it. So let's dive right in. Without further ado, I'm going to go through two scenarios. We're going to just go through numbers. Scenario one is the average scenario, somewhere else in the United States, not California. Let's assume we have a property price of $250,000. We're looking to make a 20% down payment or put $50,000 of our cash to work in that property. This is February 26th, 2023, as of this video. So interest rates are at around 6.5%. For this example, I used a 6.35% mortgage rate, a 30-year fixed rate mortgage. Okay, what does that turn out to us as a mortgage payment? And then what does that turn out to us? What can we rent that property for? I did some research on Zillow. For a $250,000 property in Utah, which is a 3-bed, 2-bath, 2,000 square foot property, your monthly payment will be $1,490, including insurance and property taxes and your mortgage and interest. And then what can we rent that for? So the exact same property in Price, Utah, as you can see here, will be $1,428 per month. That's how much you can rent that property based on Zillow's current estimate. Again, 2023, February 26th. So let's put that into what I call a pro forma. So this is a spreadsheet that has some formulas, but it's basically a tool that a property manager might use to show you, to calculate what's our actual gross rent, our gross profit, our rent against our expenses, which produces our gross rental income, and then our net rental income. So let's take a look. So here we would make $17,136 in rent. And then after we pay the monthly property taxes, insurance, and mortgage payment, as well as assuming we're going to have some maintenance expense for maintaining this property because it's got tenants in it, as well as assuming a vacancy rate of 5%. Vacancy rate is a kind of a qualifier factor that most property management companies will use, because at different points as you rent out the property, there will be points where you don't have a tenant in there. Either between tenants, you have to fix up the property, or a tenant doesn't pay their full rent, or they miss rent or whatever. So we want to assume some kind of a discount there, because otherwise we'll have what we call a too rosy of an too optimistic of an assumption, which will lead us to losing more money. So once you factor all those things in, you can see here that on that $17,136 you collect in rent, you're actually going to lose $4,000 per year in this exact scenario currently. Now that assumes you don't use a property manager. If you do use a property manager and you pay the average 8% fee that most property managers will charge, you will now lose $5,475 per year on this rental property. Okay, no judgment, just the current state of rental property in Price, Utah. Again, just chose a random metro area, certain property value. Now, what if you're in California? So I'm located in Woodland Hills, California. It's a suburb of Los Angeles. I chose a property down the street from where I live. Or from where I work, sorry, and the property price for that same 3-bedroom, 2-bathroom, 2,000 something square foot house in my area costs $900,000. So a 20% down payment would require $180,000 cash down, an interest rate of 6.35%, and the same 30-year fixed rate mortgage. Okay, what's the mortgage payment in California? Again, I used Zillow, found a property. The mortgage payment was $4,805, including interest, property taxes, and insurance. If we skip ahead, what can we rent that for? We can rent that same property for $4,514 a month. Okay, I know I just spat a lot of numbers. Let's look at this again, side by side on an Excel sheet, on a pro forma. So your rental income would be $54,168 per year on that property in Woodland Hills. After your mortgage, your maintenance, and your vacancy, you're losing $9,201 per year for holding that property. And then if you, again, that's assuming you don't use a property manager, but if you do, you're losing $13,535 on that property. Okay, so it appears based on the research that this is not a great rental market, great market to buy and intend to be a landlord. But let's just assume you say to yourself, well, what if I make the numbers work? What if I can find a better renter than this? What if that rental rate seems too low? I don't believe what Zillow's saying. I know some guy or I know some family who's willing to pay me $6,000 for that rental property if I buy it. Now, I should add one thing. This scenario is only for people who are currently actively thinking about investing money in rental property. Not if you bought it 5 years ago, 2 years ago, 1 year ago, 10 years ago. This is not for you. Additionally, this is for someone, the average middle class person in America who's intending to retire, who doesn't have $5 million of saved up cash or a family who's willing to give them $1 million loan. This is for do-it-yourself, self-made individuals who have good incomes, a relatively reasonable amount saved for retirement or saved, as a younger person, but are not fabulously wealthy, where this decision would proportionally be a large proportion of their wealth put into one investment. Okay, now let's move to this Goldilocks, what I call the Goldilocks scenario 3, where you kind of make the rental rate work. So let's say we can find a renter for that California house for $6,000 a month. That would be $72,000 a year of rental income. Now, if your mortgage stayed the same, your net rental income after everything would be $7,700 roughly on an $180,000 investment. That's again assuming you do it yourself. You don't have a property manager. So if you pay a property manager, now that rental income is going to go down to $2,000 per year on $180,000 initial investment. Okay. So that's a Goldilocks scenario. Let's take an even better Goldilocks scenario. Still, even in this Goldilocks scenario, still not looking great. $2,000 return on $180,000 invested is terrible. And then even if you don't use a property manager, $7,000 on $180,000 investment is also not super great, not super attractive. So let's say we go to the even better Goldilocks scenario. You say to yourself, well, rates are kind of high right now. I think I'm going to be able to refinance in 2 years at a better mortgage rate. Let's assume I can get this $6,000 renter, keep the $6,000 renter in there. I operate this property at a tiny gain, or maybe even at a loss for 2 years, but just so I could buy time to get better rental rates in 2 years and a better mortgage rate and refinance. What does that look like? So let's say in 2025, so 2 years from now, you refinance at 4.5% instead of 6.35, which is what this scenario is built on. On that same $900,000 home value, you don't have any change in equity. All you've done is made your payments for 2 years. Your principal balance will have gone down very, very little. So we're going to just make this on a roughly the balance that you have after 2 years of payments. So now your mortgage payment on this refinance would be $4,080 instead of $4,800. Okay, let's plug that in the spreadsheet. So let's again assume you got this Goldilocks renter, better than expected renter who's paying 30% above market rates. Now you dropped your mortgage payment by $800 a month because you refinanced at a slightly better interest rate. How much do you make now? Well, if you manage it yourself, you're managing it and no property manager, you're going to make $16,000 per year on this $180,000 investment. Now, one thing we should add is, let's say you didn't have the great renter in there for the first 2 years and you're actually operating this property at a loss, small loss, $1,000 a year or $2,000 a year, or maybe $10,000 a year, just to get to the point where you can refinance and the whole thing becomes profitable. If you're losing money for those 2 years, you have to add that back into the original invested amount, because now you've kind of fed the beast. You've given it more cash just to get through to a point where this is profitable. But in this scenario, let's assume you've had the better renter. So you're on this $180,000 initial invested amount. Okay, before property manager, you're going to make $16,000 a year. If you hire a property manager because you don't want to deal with the garbage of managing a rental property, you might make $10,700 a year on $180,000 invested. Okay. So what is the annual rate of return in each of the scenarios that we've gone through? So let's put those side by side as percents, because again, you're not comparing this, it's not about absolute dollar amounts. You're comparing this as a percent of the original invested amount, and you're also comparing rental real estate against the entire universe of other possible investments you could have made with that money. That's the root of this. Is we don't make emotional investing decisions, or we shouldn't. We should be doing this based off of careful research and evaluation. And you're never researching this in a vacuum. You're always saying, should I take this 180,000 and put it into a certificate of deposit, or into 2-year treasury bonds, or into Microsoft, or into some blended portfolio in the market, or into rental real estate, or into a limited partnership, or into oil and gas? You're comparing it against other things, right? You're not comparing it against itself. So what is the actual rate of return in each of these scenarios? Let me move my head here. So in scenario number 1, the average United States house, $250,000 purchase price, $50,000 down, you are losing 11% per year. The rents and the mortgage just don't make things work. You're losing money. In California, you lose money on that original scenario. You just lose less. Part of that's, I think, because rents are stickier in California. So the rents haven't gone down quite as much as in other areas. And again, this is metro area dependent, city dependent, state dependent. Okay, what about scenario 3 where you find the Goldilocks renter, but you don't refinance? Okay, now you're barely scraping by, $2,000 a year on that $180,000 investment. Blech, doesn't look too tasty. All right, and then what if you get the super duper Goldilocks scenario where you get the better renter and you get the refi in 2 years at a better rate, you keep the better renter. Well, now you're making something like 6% on your original $180,000 investment. So let's say, most people aren't only buying rental property for the rental income, although the stream of cash flows is nice. A lot of the time you'll say, well, what if I buy and hold that property and then eventually sell it? Property prices always go up. So wouldn't it still be good to, operate it at a minimal, gain, minimal loss, somewhere in that neutral zone? But I'm going to make so much money if I hold this property for 10 or 15 years that it's worth it, right? Okay, let's go through that scenario. So let's say you hold the property for 15 years. You sell it in 2038, and you assume the annual average rate of growth on home prices is 5%. So that $900,000 California home ends up being worth $1,780,000. You didn't take out equity, you paid everything on time, you would have a remaining balance on the mortgage of $506,000 at 15-year mark. So you can sell the house for a profit of $1,194,000. $880,000 of that is going to be long-term capital gains. Now you need to figure out what's the amount you keep after taxes. And if you run this like a rental, sometimes you can figure out with proper tax planning how to take advantage of a first-time home buyer exclusion, things like that. But generally, you're not going to be able to. So you're going to have a large capital gain. If you're in the position where this money is relevant to you, you're not going to want to do something like a 1031 exchange because you need the money for cash flow. You need the money to live on. If you're doing this and the intention is in the future to do a 1031 exchange, this video is not for you. Skip out. But the question here is you need to figure out what are you going to keep after taxes. So let's say you wanted to buy this property, you're really attached to the idea, you're okay with doing it at a minimal rate of return or even with a small loss. Well, how much are you actually going to keep of the capital gain after taxes? And that's going to be state and case dependent, but you're definitely going to keep less than you think. So the question here is it worth it to hold it that long while you're losing money or just breaking even so that you can sell it for that gain? And that's really going to be case dependent and age dependent. If you're a pre-retiree or a retiree, this is not a good idea. Because if you're 65, why are you going to buy a property and hold it till 80 when you can't use it? I mean, the best years of your life, the best years of your retirement will have passed you at that point. In addition to that, if you're in the position where you are trying to leave great legacy for your kids, that's a completely different evaluation. But if we're just talking about this on how does this help fund your lifestyle so that you can live and keep a great standard of living in your retirement, this doesn't look like a good option for the 50 to 65-year-old to purchase rental property. Now, part of that also is I have a separate thesis on home price values, and home price values don't necessarily always go up. We're in the middle of a home price value decline now. Nothing says we should continue to always have home price appreciation. And there are some demographic reasons to believe that will be the case. And I will make that a separate video. It's a longer conversation. But I believe there will be a lot more homes coming to the market for sale than will be purchasable because baby boomers are a much larger demographic than millennials and Gen Z. So there will be a lot of homes coming to the market as baby boomers go through their retirement and either pass away or die or sell their homes or leave their homes to their kids. It's going to flood the market with homes, and I don't think we'll continue to see huge home price appreciation at the same rate we did for the last 20 years. Now, separate from that, what if you're young? Okay, if you're young, maybe this is a different calculus for you. But even then, the question always is, if you're young, the best thing you can do is increase your savings rate, your actual amount of investable dollars you create per year. So if you put a lot of money into something that gives you very, very small cash flows, or you have to negative cash flow it to kind of fund holding it, you are reducing your savings rate and therefore reducing your overall wealth building ability. Now, you may be saying, well, what if I hold it and sell it later in 15 years? That might be valid, but the thing is, you can't control where the home price values will be in 10 years or 15 years. So you're taking a gamble on that, as you are with all other investments. It's just that at the same time, you're also losing money or barely breaking even while you take that gamble. So I don't know. Again, this isn't personal financial advice. I'm not telling you what to do. I'm just showing you the evaluation I go through. But part of the opinion I hold right now is that rental real estate does not seem like a super attractive option unless you can find some really great fringe scenarios where you're buying like foreclosed or repossessed homes and they're super discounted, and it's a much more different. It's a very different equation. Now, there are a few other additional things to consider. We'll go through really, really quickly as we wrap this up. You have to consider your access to the original invested amount or the liquidity of that investment. Homes take a long time to sell. You always need to have a ready and willing buyer if you even do want to sell it for the price you hope to sell it for. And like I said, it takes a long time to sell. It could take you 30 to 90 days, maybe a year, I don't know, to get your money back out if you need it. Again, other things might be more liquid, and you have to compare investment real estate to other types of investments. Then you also have taxes on rental income and capital gains, etc. So even the numbers I showed you on those spreadsheets they're before taxes. So net of tax, you might keep even less than what you're seeing on there. Then you have costs to buy the property, so things like furniture, fixing the property up, getting it ready to rent, whatever. Then you have costs to sell the property. That's broker's fees, maybe penalties, preparing the property for sale if you need to actually make it more attractive to a buyer. Then you have unanticipated costs of running a rental property, such as HOA fees or unanticipated maintenance, unanticipated vacancy. And then you have unanticipated cash needs due to other life circumstances. Let's say you get sick or you lose your job, you suddenly need access to more money, and it's locked into a rental property that you now have to sell at a discount because you need to rapidly get out of it. Not saying that's always the case, it's just you have to factor those things in. The money's locked in there. So the quick summary here, or the ending summary here, is that this is a complex evaluation that needs to be done in a professional manner. Don't get wrapped in the hype. Don't let social media kind of sway you one way or the other. Don't let emotions sway us with decisions about our money. This is complex. And if we had a specific property we were evaluating, we would do the same evaluation using the same tools to figure out what this would look like. I just use general ones right now. Owning a rental property is running a business. It is not passive income. It is not passive cash flow. You have to run a business. You have to keep budgets. You have to manage maintenance schedules. You have to find tenants. You have to manage your tenants emotionally and psychologically to make sure you get paid on time. You have all sorts of considerations. If you hire a property manager, you're going to pay a fee for those things, but you're then going to have to manage your property manager. So it's running a business. It's not passive income. The question then is, does that fit with your desired lifestyle based on your age and your goals? And I would argue for many people that doesn't. We tend to be convinced through the marketing apparatus or the media that all these other things are ancillary and don't matter, but they do. You have bad tenants when you run rental real estate. You also have disasters happen or mistakes or whatever, and they get costly, and they detract from quality of life. Not to mention, if you're a pre-retiree or retiree, maybe you want to travel, maybe you have family in different locations or kids that don't live near you, and you don't want to be anchored to one coordinates on the map because you bought a rental property there and now you're stuck, right? Work with a professional to do this evaluation, and specifically I'd say an unbiased professional, because let's be real. Incentives drive all advice. Real estate agents get paid for selling property. So a real estate agent is incentivized to show you reasons why you should buy a property, even if it's not the best option. Same with a commercial broker. So what you really want is unbiased advice. Now, I'm a fee-only fiduciary financial advisor. I don't get paid through commissions. I don't get paid through any referrals or kickbacks. My fee structure is designed so that I show clients evaluations of the different investment options that are arrayed for them without any bias to choose one over the other. And that allows me to give you this kind of presentation. Like I don't make more money or not make more money if you buy rental real estate. It doesn't affect my compensation. So I can give you an unbiased evaluation. I'm not saying I'm the only one who should be able to do that. There are plenty of people who can. Just be wary that you're getting professional advice from someone who is unbiased about and whose livelihood is not dictated through the sale of a rental property to you or property management services or whatever. Okay. Now, the last thing here, and I've already mentioned this in the presentation, is the evaluation's not done in a vacuum. You are comparing this investment option against other investment options so that you can make the best choice for you at your stage of life, at your age, your asset allocation, your level of wealth, your desired rate of spending, your family, your health. Those things all matter. So this can't be done in a vacuum. The last thing I'll add here is as a fee-only fiduciary financial advisor, I help clients make good decisions about their wealth building strategies or their financial independence strategies, how they produce income in retirement, how they save as a younger person to create that income in retirement. And I recommend you watch this training video that I've offered, which is called How to Increase Your Retirement Income by Up to 30% and Avoid Running Out of Money in Retirement. This is for all ages, all people. It shows a set of behavioral decisions that you can influence directly, personal behaviors, to create better outcomes in your financial independence years. And you can start this at any age. It also describes and helps you understand how to navigate the financial services industries, what types of professionals to work with, how do you ask them the right questions, what are their qualifications and their fee structures, so you can make sure to work with unbiased sources who will give you the best advice. That's it for now. I hope you enjoyed this presentation on how to evaluate rental property decisions for financial advice clients of mine. If you have questions, please put them in the comments. If you like this video, give it a thumbs up and subscribe to my channel. If you have suggestions for other videos, please let me know. As an end note, I will also make that follow-up video on my economic outlook for the housing market and rental market separately. But again, thank you for your time and your attention. I appreciate it. Your future self will thank you for watching this video if you did get this far. And I hope to see you or speak to you at some point in the future. Take care.